This is the Friday, November 24th, 2017 version of the Market Plus segment. Joining us now is Don Roose. Don, thanks for joining us.
Thank you, Mike.
I hope you had a happy Thanksgiving. I suppose we're cheating. We're recording this on Wednesday, but Thanksgiving's tomorrow.
That's right. We'll look forward to it.
You betcha. Well, now we've got some great questions here from our followers on Twitter and Facebook. We're just going to run down the list. Don, get your thoughts. Tim in Crookston, Minnesota on Twitter at $6 Wheat Guy wants to know, do you have any early guesses on the 2018 crop planting intentions? What's hot and what's not?
Yeah, that's a good question because right now it looks like probably the corn acres could be up 1 million, up to 91.4.
Okay.
So your carryout goes up again. It looks like the soybean acres could go down 500,000, 600,000. It looks like the wheat acres probably do go down 400,000. Remember, we're already at a 108-year low. So I think if we get big yields again, you're talking about carryouts probably trying to grow again.
Now, looking at profitability, I mean, you look at 18, Nov 18 beans and Dece 18 corn, I mean, beans have to be the more profitable option, don't they, given average yields? Why are farmers switching to corn?
Well, I think it's in the areas, when you look in the wheat areas, trying to go to more corn. But I think also, it really what's held the producer together more so than anything else has been the big yields that we've had. And so the big yields on corn have trumped, if you will, the soybean yield. So I think that's really what it is. I think the gross dollars per acre, and you have a better chance of getting a bigger yield, more dollars on the corn versus the soybean. So that's the way we're looking at it right now. But as always, when you're looking that far out, it's up to the weather.
You betcha. Now, speaking of weather, John in Jessup, Iowa wants to know, are the days of $5 corn a distant memory? Is there any weather event that can get us back to $5 corn?
Well, I think if you look back, I mean, years back in the 80s, it was always tough to get to $4. And it was really a $2 to a $4, and it was really a $2 to a $3.50. I think where you're at right now is we're really in a $3 to a $4.50. And if you get some big weather events, I think you can go to the $5 to $5.50. You have to remember that we're in a negative situation right now, but we're also changed. Our consumption is huge. We need to raise a 4.5 billion bushel corn crop almost every year, or 14.5 to 14.5 billion bushel corn crop. So that's a big number, you know. And the same thing on the soybeans. The consumption's 4.3 billion bushels. So it's nice, you know, to have a big carryout, but it can disappear pretty fast with weather.
Now, if we look back to 2016, we saw Brazil have trouble with their corn crop. It got very, very hot, very, very dry. The corn just didn't perform, and we filled that gap, but we didn't get much of a bounce in price. That was what took us up to, what, $4.50 almost in 16. So even if Brazil is catastrophic, would $4.50 be about the top? We need a weather event here to take it to $5, do you think?
Well, and you've got some good points, Mike, because I think really where we're at is in the olden days when we didn't have South America as a big competitor, it was the United States. If we had a problem, the world had a problem. Now, when we have a problem, right away everybody starts to look, can South America save you? And vice versa. So you almost meet up back to back, South America and North America problem, which can happen. But I think that's right. I think big problems take you up to $4.50, and even last year you could only go to $4.17.5.
Yeah. All right, well, now we're going to go big picture. Aaron in Wisconsin at A. Gunterberg on Twitter wants you to look back at the farm economy issues of the 1980s. Were there any precursors in the years leading up to the downturn, and have any of those signals been relevant in this current ag economy?
Well, the big thing that we had in the late 70s and the 80s was just a euphoric situation. The break-evens didn't work. You were banking on inflation. So what have we had the last time? We had a euphoric situation. We had $8 corn, and we were banking on we're going to have a new level, you know, $7, $8 corn. You're going to have $18, $20 beans. That euphoria is also built into the market, and we have low interest rates that are built into the market where we had high interest rates in the 80s.
So the low interest rates, Don, that's going to be a savior of the farm economy this year, do you think?
Well, I think the big risk is that we probably pushed our asset values too high. So you can take, you know, a cheap interest rate, but if your asset goes from $8,000 down to $5,000, you still lost your net worth. So that's part of the issue, I think, that's concerned. So yeah, we do have some similarities, you know, that are some big issues.
Now, one of the things that I hear from a lot of different growers, and of course, you were farming during the 80s, you remember this, I don't, but they say that really what happened, or one of the catalysts for change leading into the downturn, was shutting off the Soviet Union, the grain embargo and Jimmy Carter's embargo in 1979. Our question here from John in Jessup, Iowa: what would happen to you American farmers if the U.S. pulled out of NAFTA? Would that be a similar effect?
Well, I think what we're talking about is demand, and are you a reliable supplier? And what happened in 1980 was the Jimmy Carter did impose an embargo, and the market went down the limit just like that. And it took us years to regain a reputation that we were a reliable supplier. So right now, it's a very dangerous situation with NAFTA, very much similar, that if we do things that show that we're not a reliable supplier, it's a big issue. So we'll see. It's going to be it's treading on thin ice.
Now, have you heard any chatter in the market? Is the trade built staying in NAFTA or bailing out of NAFTA, one or the other, into pricing as we see currently, or are we just waiting?
I think we're just waiting. We just have too big a supply out here, but we do have our competitors, South America, the Black Sea area on wheat. They're sneaking in and they're making alliances with some of our big customers. So I mean, it's a dangerous situation from that standpoint. So yeah, we need our trade because we produce too much, is the bottom line, Mike.
Too good at what we do in the countryside.
We are.
Now, Don, one of the stories that, of course, gets bandied about as we hear the Federal Reserve say they probably going to raise rates again soon. We're going to have a new Fed chairman as we get into 2018. What are your thoughts on the dollar? Are we going to continue to see this thing strengthen, or have we found a new channel here below 95?
Well, theoretically, if interest rates go up, then we should see the dollar firm up. That's not good for our exports. But, you know, if you look at the balance tables around the world, we're the best of the worst. So I think still. So I think you have to say that we led the world in some of these fiscal measures to stimulate the economies, and now we're going the other way at artificially low interest rates, and we need to move them back into a normal situation. And when we do that, that's probably dollar positive overall.
Now, how big of an impact would the dollar index, for ease of clarity, we closed on Wednesday, of course, at 93 and change. If we push back up towards 100, say where we topped out here on that last rally, would that actually be detrimental to exports, or would it be more of a psychological factor in the markets?
Well, you take each 10%. Let's just take 10% on the dollar. If you take $10 beans, I mean, that's $1. So it's
$11 beans.
Right, it's a big deal. And remember, the dollar, when it came on the board when we were trading against the euro, it came on in the Bush years at 120.
Oh, so we've got a long way to run, potentially.
Well, yeah, I mean, we have a big wide range, you know, from 120 to the high towards what were we in the low 70s.
Yeah, low 70s,
right.
72 during the crisis, or at least back in 2012.
Exactly.
Okay, well, not exactly very uplifting. Don, before we let you go, do you have anything we can get excited about as we head into the holiday season here as agricultural producers in any commodity?
No, I think in all the commodities we do, because if you look at it, in almost all the distant months on livestock and on the grain, we're above the cost of production. So you can do something from a risk management standpoint to lock in some profitability. You can do it today. You can do it as far out as 2020.
All right. Well, Don Roose, thank you so much. Glad you gave us something to look forward to, or at least some profitability we can put in our pocket today.
That's what we like to look at.
You betcha. Now, folks, this is the time of year, as we mentioned, to write Santa your wish list, and on ours is to include you in our market-to-market classroom project. We're looking for current students to submit their big picture commodity questions and then have them answered here in Market Plus. So join in our reindeer games and send us your questions in video form. You can direct message us on Twitter or send an email to market2market@iptv.org. Once again, thank you, Don Roose, for joining us.
Thank you, Mike.
And folks, join us again next week when we'll revisit the highs and lows of the Bakken region, and Sue Martin will sit across from me at the Market to Market table. Until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.